I'm up 101% year to date, just over $100,000 from this one statistic. 99% of traders fail. In this video, I'm going to introduce you to the trading model that will put you into that 1% of traders that are profitable. Let's get right into it. What is going on, guys? Mr. Zink here. The concept we're going to be talking about in today's video is option selling. I trade these two option selling accounts live in front of my Discord members every single day of the week. So if you're interested in checking that out, go and click that link in the description. We take advantage of this set of statistics right here. Rather, this one statistic. 99% of traders fail. This is the same for options markets, typical investing markets, or futures trading. Now, if you're familiar with futures trading, you know that prop firms, they're all over the place right now. The way that prop firms make money, according to Google, proprietary trading firms or prop firms primarily generate revenue through a combination of profit sharing with funded traders. We know that's probably not where most of their money comes from. Most of their money probably comes from fees from evaluation challenges. 99% of traders that go through these prop firms end up blowing up their accounts, have nothing but a couple $1,000s spent on evals, nothing to show for it, and then they end up quitting. That's how prop firms probably make most of their money. If we do a quick little search on what percentage of traders, day traders, make money, 1 to 3%. What we're doing is we're taking advantage of those 99% of traders that lose by selling options to them. We essentially are becoming a prop firm, or the house of the casino is the analogy I used to use, but prop firms being so relevant now, I like that one a little bit better. We're going to 3 stocks. It's all I trade: Tesla, Nvidia, and Bolt. We're going to these 3 stocks, and we're saying, okay, if Nvidia goes down, let's say 10%, that's a pretty big dip on Nvidia. We're going to go and sell some puts into that. If Nvidia pops up, we're going to sell some calls into that. The strength or weakness that is involved on this chart spikes the premiums that are on the option chain. Those options then get bought by day traders, and we know 99% of those traders fail. So most of those options that are bought, 99% of them to be exact, are probably going to expire worthless, or the people that bought those contracts are going to lose money on them. If we're the ones selling those contracts, we're going to make money on that position. Now, what most option traders don't know is that when you go and buy a contract, regardless of the expiration, regardless of the strength in that asset, you are paying an interest rate to hold that position. In this example, and this is covered via theta decay, the theta decay on a 150-day expiration contract is 0.18. 120 days, 0.21, 90 days, 0.23, and so on. The closer that contract gets to expiration, and we've all seen this if you guys have ever traded options, if you buy it on a Monday, the stock does nothing for Monday, you lose 20, 30 bucks. Even though the stock didn't go down, it didn't hit your stop loss, it didn't go up either, you lost $30 just for being in the position. That's the interest rate that option sellers are capitalizing on. If you buy a contract on a Tuesday, Wednesday, and you hold it till Thursday or Friday, and the stock has done nothing, you're going to be down 80% in that position. Go to the other side of that equation. If I sold you that contract, the stock does nothing for the week, I'm going to be up 80% of my position. That is how we are capitalizing on the moves in the market. Even though the market has been sideways for quite some time now, I'll go to the 24-hour on Nvidia. Nvidia hasn't really done anything for a full month. July 29th was the last time that we were at 178. We're at 178 right now. A whole month of sideways action, 4 weeks of selling options that will expire worthless. If we're on the selling side of that, we're making boatloads of money from doing nothing. If you're on the buying side of that, you're pulling out your hair because you're losing money left, right, center. The stock's not going up or down. You're trying to capitalize on short-term moves that just aren't happening. Go to the other side of that, become the house, or the prop firm in this case, Start selling options in this market, just in general. Worst case, you're going to add the shares at a discount. Best case scenario, you're going to make 100% of your options position for literally doing nothing but waiting. Now, the question that I get asked most often is knowing when to sell options positions. Sell cash secured puts, buy back covered calls, whatever it might be. So I'm going to break down how I open trades on Tesla via TSLL using data from Edgeful. So first off, I go over, chart my trades on Tesla as the main ticker that we use, but I trade them on TSLL. TSLL is $12.80 a share. Tesla is $340 a share. I don't want to go and spend $34,000 per position on Tesla, so I go down to TSLL and I spend $1,200, $1,300 per position. Charting on Tesla, and we're going to use Wednesday, August 20th for this example. I go over to Edgeful and I look at the opening candle continuation data point. What this tells me is the percent chance of a green or red day based on the first 30-minute opening candle. The opening candle size, 30 minutes, 78.95% chance it's going to be a green day if that opening 30-minute candle is green, 72% chance that it's going to be a red day if that opening 30-minute candle is red. Going over to Tesla, okay, I see that first opening candle is red. Now, along with that opening candle continuation, I go and use the initial balance breakout report. What this report tells you is that there's a 73.6% chance that there will be a break of the high or low formed in the first 60 minutes of market. I go over to TradingView, turn on initial balance breakout indicator by Edgeful. There's my high, there's my low. I know that there's a 73% chance that one of these levels should get broken. Using that alongside the opening candle continuation, I know that if the first 30-minute candle is red, there's a 72% chance that day is going to be red. If the first hourly range is formed with a high and low, there's a 73% chance that one of those levels is going to get broken. I like to sell my puts when the low is broken on that 60-minute time frame. Edgeful also gives you strike prices that you can aim for by levels on this initial balance breakout. The reason that I like to sell my positions when the low is broken is not because I'm trying to time the bottom perfectly, but the percent chances that there will be further downside or further upside once that level is broken is pretty slim. There's only a 1 in 5 chance that there will be a half standard deviation target. That standard deviation target is the size of that initial balance, and then it's just half a standard deviation, which is that midpoint, 1 standard deviation, so on and so forth. Using this data point, again, a 1 in 5 chance that Tesla will go and hit that half standard deviation, a 1 in 10 chance that Tesla goes and hits the 1 standard deviation, and then the levels just get extremely rare from there on. I like to sell it once it hits the first break of that initial balance because I average into positions. If it continues lower, I'll add more at half a standard deviation. If it continues lower than that, I'll add more at 1 standard deviation. Most of the position I open is at the initial balance breakout as soon as that happens. If you're interested in checking out some of these Edgeful reports, I also have a link for them in my description. They give you a 7-day free trial. I highly suggest using these for removing emotion from the equation in your trading journey. Go and check them out below. Now, what happens if I want to know when to sell the shares now that I've been assigned on the cash secured puts? I use that same report on Edgeful, the 30-minute opening candle continuation. This one has a near 80% chance that this day will stay green if that first 30-minute candle is green. Friday, August 22nd, that first opening 30-minute candle is green. Okay, great. I'm looking for the day to stay green, and I'm also going to use my initial balance breakout report, knowing that there's a 73% chance that the high or low formed within that first 60 minutes is going to get broken. 30-minute candle green, great. I'm looking for the second 30-minute candle to go and form the high. I'll either sell my positions there or I'll sell some calls against my shares there. Simple as that. We're still capitalizing on data. We're capitalizing on significant data, both with Edgeful and knowing from all the reports out there. Again, just Google it, what percent of day traders make money? 1 to 3%. We know that 97 and 99% of traders that are buying the positions that we're selling aren't going to make money on those positions. If we're selling them to them consistently, as well as knowing when to sell them using Edgeful's data, we turn into that 1%. Hope you enjoyed this video. If you have any questions, drop them below. Like, subscribe. I'll see you guys next week for another video.